And so this is what I'm showing you here on the screen, the theoretical diagram of what I just said. The fat blue line is showing you the tidal wave in the sea, or the long-term trend in the market, and that tends to be 1 to several years. The turquoise zigzag line is showing you the waves in the sea, and this is anything from several weeks to a few months in the market. And the dotted red line, which is even more volatile and even more squiggly on the screen, is showing you the ripples in the sea, the very kind of small, subtle movement in the sea, which in market terminology tends to be multi-day to several weeks. So the long-term tide or the long-term cycle is very much kind of maybe where investors focus most of their time, or just people like me maybe look at on a regular basis just to understand the big picture cycle, the macro picture. The medium-term or cycle, or the waves in the sea, is what probably everyone looks at because it impacts each cycle, long-term and short-term. And this is actually good for understanding potential rises and falls in the market, because it'll give a kind of overlay in terms of how high that market will move into the long-term cycle, or how far will that price fall into the short-term cycle. And then finally, short-term, the ripples or the multi-day to 3-week short-term cycle is very good for timing. So a lot of you are probably traders here, and here at MIG Bank we produce a lot of short-term trading strategies in our model portfolio. And so the short-term time frame is quite critical for actually choosing entry and exit positions in the market. So some of the questions being asked here is, what is the best method for simple retail traders to access and track cycles? I mean, the very short and sweet answer I'll give you is moving averages is a great way to actually isolate the different cycles. Of course, you want to look at intraday charts, daily charts, weekly charts, maybe monthly charts. That's an easy way for the average day investor and trader to look at cycles. But on the daily, weekly, and monthly charts, overlay moving averages. So simple moving averages, or any other average that you might find suitable. The moving averages, which I tend to recommend, 20-day moving average for a short-term cycle, 50-day moving average for the medium-term cycle, and 200-day moving average for the long-term cycle. Remember that a lot of people in the market, traders, technical analysts, and investors, and even economists, look at the 200-day moving average on a regular basis because it's just a long-term benchmark. The 20-day moving average is also used quite a bit because 20 days is the average number of days in a trading week, in a trading month, I should say. So 20 days is the average time duration, time cycle within a month. So 20-day moving average, 50-day moving average, and 200-day moving average, these are good moving average overlays to isolate these three cycles. And someone's asking waves correction 1/3. So where I said correction 1/3, the medium-term cycle, the turquoise line, just shows you that sometimes it shows you that markets tend to fall by 1/3. They tend to lose 1/3 of their value, and it tends to be the medium-term cycle that you can actually identify that retracement, that price fall or rise. Okay, so there's cycles, and we're just basically talking about how cycles start from the big picture. That big tidal wave that is coming at you, history catches up with you eventually, and so it's very important to understand historical events, but also historical time cycles and price patterns. Keep in mind that the tidal wave affects the waves and the ripples in a kind of a fractal way, and the long-term tide or the long-term cycle is 1 to several years. The medium-term wave or the medium-term cycle is several weeks to several months, and markets tend to correct 1/3 of the medium-term cycle. And then finally, ripples, the short-term cycle, which tends to be multi-day to 3 weeks. And this is quite good for timing. Keep in mind that the best way for each of you to analyze cycles, the very simple way, is to use moving averages. Short-term cycle, look at the 20 moving average. Medium-term cycle, look at the 50-day moving average. And long-term cycle, look at the 200-day moving average. Now, what I want to say is that although the US dollar has lost half its value since 1980, which is a big statement, it's quite bearish, keep in mind that, theoretically speaking, this is where I believe the US dollar is at the moment. So we are in this long-term down cycle, this big fat blue line, the tidal wave or the long-term cycle in US dollar is down, but along that path, along that roadmap, we are currently seeing a US dollar recovery, which is just part of the multi-cycle overlay. So this is the US dollar recovery, which I believe will probably gain up to 30% in the next 6 to 12 months. And this is how it looks. If you look at kind of 2 or 3 cycles overlaid, this is how it would look on the roadmap, on the cycle roadmap, according to my analysis. Is that clear to everyone? I've repeated some of these ideas a few times just to make sure it's very clear to everyone in the chat. I want to make sure that everything that we're talking about is clear and actionable for each of you here in the webinar. Okay, so US dollar recovery, short to medium term cycle within a long term down cycle. So yes, someone's asking me, then it will tank. Yeah, I mean basically my long term view on the US dollar is very much in line with what it's been doing since 1980. The downtrend. The US dollar is very bearish. It has lost half its value, and most markets which lose half its value tend to continue to lose value. And, technical but also economic situation in the US is bad. It's just at the moment there are various reasons why the US dollar is due a recovery in the short to medium term cycle. Technically, the market is unwinding from very oversold momentum and sentiment and liquidity extremes, but also from an economic standpoint, there's a flight to safety. And as everyone said in the chat at the start, because that there's a decreasing amount of safe havens for investors and traders to put their money, to hide their money, the US dollar is actually taking a very positive, a renewed interest because of the fact that Swiss franc has unwound somewhat, and because of various other markets which are traditional safe havens. Okay, someone's asking, someone saying thanks Alan Greenspan, another person saying, or the same person's even saying, Paul Volcker drove the US dollar to all-time highs, just for the record. These are all valid points, and obviously the monetary policies which each of these central bankers choose to take over time definitely impact the market. And in terms of the US dollar, the zero interest rate monetary policy that the Fed Reserve in the United States has chosen to take has certainly made the US dollar less attractive historically. Now, this is a very important chart where I'm going to show you these long, medium-term, and short-term cycles, but I'm going to show it to you on the chart of US dollar. So if you could please really focus on this chart, because it's going to start step by step from simple, and then it'll start to overlay a bit more kind of advanced overlay. So if you can just focus on the different stages that appear on this chart. So this is the US dollar index, showing you the US dollar index going back to the 1980s. So it's a 30-year historical monthly chart of the US dollar index. And so the long-term cycle we can all see right now. The long-term cycle on the dollar index is definitely down. That's what I started this webinar with, by telling you that the US dollar has lost half its value from that 1980 swing high. So that's a long-term cycle, and that's what a lot of investors and traders have kept in their minds. Psychologically, people are bearish because of the fact that the market's been going down for over 20 years. And so for that reason, people just extrapolate what's happened in the past. They just continue to expect in the future what happened yesterday and before. But keep in mind that there are medium-term cycles within long-term cycles. And so this is one example of a medium-term cycle which gained up to 96%, and then obviously we had the capitulation thereafter. Then we had another medium-term cycle which drove the US dollar up 50%. And then last but not least, the one that I'm speculating, a potential 30% medium-term cycle which runs into this long-term trend line.